And let's get started. So today's topic of discussion will be pros versus beginners. What you don't know. I apparently spelled it wrong. So as it reads, it says what you don't know. Don't know. I mean, spelled it wrong. Clearly can't spell, but it's okay. So let's move on to the S&P 500 because we're going to be making some notes. Everyone get your notepads out, and then we can kind of get this session going. So, pros versus beginners. What you don't know. That is a topic of discussion for today's kind of live stream, right? So, essentially, when someone says pro, right, in the chat, what do you guys think is the meaning of a pro, like a professional trader? Like, what do you guys have a definition for that? Sean says full time. Stepeat says institution. Okay. Make a living off of trading. What else do we have here? Daily trading with profit. Okay. Some definitions here that are coming out. Someone who trades responsibly and lives off it. Okay. So, what is a professional trader? That's not spelled right. What is a professional trader? So, essentially, my understanding of what a professional trader kind of is, to me personally, is it's someone that doesn't necessarily trade daily. You don't have to trade daily to be a professional. You don't have to be an institution. You don't have to trade for a bank to be a professional trader. The definition of professional, like if you look up the definition of professional, I'm 80% sure that the definition is that someone that gets paid to do something. It's a profession, right? So anyone that is doing something, if it's like skydiving, skiing, working as a broker, it doesn't matter what you are. If you're doing it and you're getting paid, that's what professional means. Okay. So after saying that, is you don't have to be trading every day. Some professional traders don't trade every day. They come into the market once a quarter, even. Like they come in, boom, bam, they get in and out of the market once or twice or 3 times a year. Some people trade every day. Some people scalp the 1 minute chart. Some people get in and out on a weekly basis, right? There are some traders out there that literally trade daily time frame. They wait for a break, take a long, then they'll make $1 million, and they'll be like, "Cool, I'm set for the year," or "Cool, I'm set for this quarter." All right. Professional doesn't necessarily mean you're trading every single day, right? Professional doesn't necessarily mean you're making daily profits every single day. But I can tell you now that even if you're a professional trader, you're going to have a bad month. Okay, it happens to everyone. Everyone that is a trader in the community, everyone that is taking trading on as a professional or that wants to take it seriously, you need to understand that there are negative months. You will be in drawdown for at least 1 month a year. It is a reality of trading because obviously you might be going through something personal. You might have something going on. Markets might be a bit slow. Markets might be too volatile for you to trade. You might get stopped out here and there. Like that's just the only thing, right? So what I want you guys to get into your head is that a professional trader is a trader that makes money, right? It's just a trader that makes money. It doesn't have to be an institutional trader. It doesn't have to be a specific type of profit. It doesn't have to be like there's no limit to the profit. It's just someone that is trading and making money. If you're making $20 a day, if you're making $200 a month, doesn't really matter. If you get paid doing it, you're considered, quote unquote, to be a professional because it's your profession now. Okay. So that's an important thing to understand on top of that, right? So what do professional traders do that retail traders don't? Right? So like when I say retail, I mean like the average person that just joins into trading today and decides to trade, right? I want some answers in the chat now. So what do you think a professional trader does differently to quote unquote retail trader, right? So I'm going to ask you guys what you think first, and then I'm going to tell you what I think, or what I've seen, or what I've collected data on. Does their homework? Okay. understands the market differently, I guess. Less precise trades, retail FOMO and trade very often, okay. Planning ahead, study the market and then act. Their mindset is different, top-down analysis, understands and follows risk management. That's an important one. Vicky has it on the dot. Are smarter and have more resources to execute trade profitable. Okay. So, okay. What do professionals do differently? Let's do that. Let's copy and paste this down here. Okay. Essentially, off the top of my head, right, the first thing that comes to my mind is when I think about a professional trader, or like what I've seen over what I have watched or read about, is that professional traders understand risk management. Right? What does that mean? Okay. So this is what risk management means. Okay. You have $100 account. Okay. I'll break it down first and then I'll go into detail. You have $100 account. You trade that account this month and you lose $10, so now you're on $90. Okay, now you have $90 in that account. All of a sudden, the professional trader understands my account is down 10%. So now I need to de-risk on my account. So instead of taking the same size risk, they would half their risk. Okay, so how do you as a trader do that? Okay, someone give me any account size. Someone give me any number. 1K. Okay, 1K. So $1,000 account. Okay, let's just say you have $1,000 account. How much are you risking on a $1,000 account? How much percent are you guys risking per trade? 1%. Okay, 1%, 2%, 5%, 10%, 0.5% says Mad Crypto. Okay, that's like nothing. Man's like got his risk management under control. 5%, 5%, 50%. Come on, bro. Okay, so here we go. Let's break it down. Okay, if you risked 1% per trade, okay, you have to lose 1,000 trades. I'm sorry, you have to lose 100 trades before you blow this account. Okay, if you risk 10%, you have to lose 10 trades to blow the account. Okay, so now we understand that, right? The lower the risk percentage on the account is going to be, in the long run, a better situation to be in because you are able to take more trades before you lose the account. Okay, now that we understand that, let's take a look at understanding where would we de-risk on our account. Okay, so risk management is understanding when to take more and when to take less. So if I have $1,000 account and I take and I go on a losing streak and I lose 5 trades in a row, okay, and I risked, let's just say 10%, right? This account should essentially be down to $500. At this point, my account is halfway down. This isn't where you want to be sitting when you decide I want to start lowering my risk. This is like way too late to be lowering a risk because the time that it gets you to make this back would be quite a while if you lower your risk now. Okay. So what I always tell people is you have to set a profit target and you have to set a profit loss, or like a loss target. So what I always go by on my accounts personally is if I lose 10% of the account, that's the account as a whole. If I lose 10%, I'm de-risking on that account. Okay. So my starting balance is $1,000. If I lose $100 off of this account and I'm sitting on 900, I'm de-risking. Okay, let's say I lost 5 trades in a row. Now I'm on $900. At this point in time, if I was risking 1% per trade, actually let's say 2% per trade, right? I'm risking 2% with $1,000. If my account drops to 900, if I went on a losing streak or if I won 1 and lost 4 in a row, Doesn't matter if my account gets to 900 and I lose 10% of my starting balance. I'm going down to 1%. I'm risking 1% of this new balance. Okay, so essentially, I risk 2% of 1,000. That's my starting. Okay, I risk 2% of here. If this number goes to 950, I'm still risking 2% of 1,000. Okay, I'm not changing. I'm not risking 2% of my actual balance. I'm risking 2% of the starting account size. Only when I hit 900 is when I will start risking 1%. And then if I lose 10% of that, which should take me down to 810, I would risk 0.5%. Right? The reason why I do this is because if I went on a losing streak, right? Let's say I went on a losing streak at $1,000. I had $1,000 account. I was trading that account. It was going well. Boom! All of a sudden, I have a bad month. It protects me from losing the entire account. Okay, so if you look at it like this, right? If you take a 2% trade with $1,000 and you bump it down to 900, right? Now you take 1% trades off of 900. It'll take you a while before you get to 810. Even if you lose every trade in a row, if you're only risking 1% of that initial balance, it'll take you a while to get down to 810. Once you get to 810 and you lose another 10% after this, you're down to like 0.5% like per trade that you're risking. And essentially to get from 810 down to like 700, it's going to be a while. Like you'll have to take a ton of trades on a 0.5% risk of this amount to get down to 700. It's actually crazy. Like I don't think you could do it. Like unless you really are not a profitable trader, I don't think that is possible. Like if you're following proper risk management, yeah, that's the first thing, right? So the next thing I want to talk about is profit targets, right? So moving money upwards. So obviously we've now stated, okay, we're risking 2% on this account, right? When do we start risking more? Right, so that's personally up to you. But for me, it's whenever I make 50% on the initial balance is when I'll start risking more. So if I go from 1,000 to 1,500, right, I've made half that back. Then I will update my risk, right? I won't start risking 4%, no. I'll start risking 2% of the new balance. So I'm risking 2% of 1,000. Over here, I'm risking 2% of 1,500. Okay, essentially then you keep going on. So what's half of this? So it would be 750. So 1,500 plus 750. Someone do the math for me, please. 225. 2,250 is when you update it again. Then you say, cool, 2%. Same thing, 2% of the new balance, right? If this account goes to 1,800, I'm not risking 2% of 1,800. No, not doing that. We're risking 2% of 1,500 still until we get to the new balance, right? Then you keep going up. But obviously for you, it might be different. For your trading style, it might be different. For your strategies, for how much you trade, for how often you trade, it might be slightly different. So it's all dependent on how much you actually want to risk. So you could have $1,000 account and you could essentially then go in and say, when I get to 1,200, I want to start risking more. When I get to 1,300, I want to start risking more. Like it's all dependent, right? Same with you. If you want to start risking more to 1,900, it's all like one by one, right? So it all depends. That's the most important thing. That's understanding risk management, right? It's when to de-risk and when to apply more risk, right? If you think a move is going to go good, like if you think this is the perfect setup, this can't go against me, and you change your risk and you leverage more or you apply more risk than what you would have normally applied, that's not following the rules. And if you don't follow the rules, you're going to lose the trade in the long run, right? So that's the most important thing to understand is risk management. Okay. So next thing, right? So the next thing I want to add in here is something quite interesting. And that is not something specifically what pro traders do, but it's something that I just want to add is pro traders don't trade outside the office. Okay. The reason why I added that one in is because I watched something recently where an ex Wall Street trader or ex Wall Street broker was asked the question, "Do you day trade when you're at home? Like if it's like a holiday or if it's like you don't work there anymore." This guy's an ex Wall Street trader. Just remember that he doesn't work on Wall Street anymore. They asked him, "Hey, what's up? Do you trade now that you don't work? Do you day trade now that you don't work on Wall Street anymore?" He says no. The reason why is because the guys in the office have access to information that normal people don't. They have access to the order books. Like to get access to the order books, on my knowledge, from what I understand, is your company needs to be trading a certain amount um, per month or per year to give the company access to the actual order books, right? Also, if you go into like a real broker and you like take an order manually, like you go in and you tell them, "Hey, what's up? I want to buy $2 million worth of Tesla," right? They put those orders in. So they know exactly when your money is going to go into the system because they can see the order book. They have that information. So they can trade with your money and they can trade with your trade, essentially. Right. So it's understanding that when you're outside of the office or when you're outside of home or when you're not in front of your PC, you shouldn't be trading necessarily on your phone. Right. Because there might be something you might miss. You might have a smaller screen. You might be in a different mindset. Right. So for example, um, if you're in the office, if you're in front of your computer, you're in that mindset of I'm trading now. I'm doing this now. This is what my brain is now programmed to do and look at. If you're outside sitting at a restaurant or if you're outside on holiday with your family, you shouldn't necessarily be in the same mindset or looking for trades at the same time because you might not see the same setup. Now, it doesn't. Now, what I'm saying here is I don't say that you shouldn't set alerts and come back to it later. You can definitely do that, right? I'm saying is you shouldn't open up a new chart and try and chart it on your phone because there's something that you might not, that there's something that you might miss. Okay, you can essentially chart something on your computer, set your alerts, and then you can then say when these alerts trigger, I'm taking a position here or here. Then you can head out of the house, you can go do something. As soon as your alert hits, then you can take your order. I'm saying that, right? So there's a fine line between the two. There's a difference between opening your phone and charting on your phone and actually charting on your computer, being in this mindset of I'm gonna win, I'm gonna trade, I'm gonna make money, and then setting an alert and then leaving, right? So, for example, in the mornings, I normally hop onto my PC and I do some charting for about 15 minutes while I have a coffee. Directly after that, I go straight to the gym. Okay, and this week there was 2 days, I think it was 2 days, where I charted charts and I set my alerts and I went to the gym. And for some reason, my alerts didn't trigger while I was at the gym. Okay, and when I got back to my house, the charts that I had already charted out had already tapped the zones and rejected off of the zones. So I missed the order. Instead of me coming back home and trying to rush it or trying to quickly go, "Hey, look, I need to get back into this order. I need to find a way to get into this position." It's fine. I missed the trade. It's not a problem. I'd rather miss the trade than take a loss on something where I'm just entering because I'm entering. Right. If I go to the actual chart that I saw, it was this chart in the 30 minutes. It was this gold position on the 30 minutes. And it was last week. Let me actually just check dates here. It's last week, Sunday. It was the 26th. Nope, sorry. It was Monday. So it was the 27th. It was here. This is the time when I was drawing out zones for gold. Right. This was last week, Monday. And this was the zone I was looking at for gold. Right. I told myself, if we get back up there, I'm taking a short. Okay. I waited that entire week for that short to play out. Right. You can see it's going to play out. You waited that entire week, started building liquidity, came all the way down, and I was waiting. Like this was on Monday. Like this was Monday, bro. And then I waited, dude. I was just sitting here looking at the chart, like, okay, I can't take any orders right now. There's no zones it's tapping into until all of a sudden, boom. Wait, it wasn't there. It was... I'll show you exactly where it was. There. Let me just double check this. Move this out the way. Double check times here. Yeah, this was 8 in the morning. 8 in the morning is exactly when I was at gym. So my alert was set for... was literally set above this high. Right, so I told myself, we tapped the zone once. Okay, then we came down. And I thought that we would most likely come up and break the high again and then go into that zone and I could short off of there. We went straight up there and won like 2 30-minute candles, and boom, we rejected it instantly. And the order that I had would have played out there. Stop loss would have most likely been above there for a 1 to 5 basically. Okay. But, and if you guys like this, I'm being dead ass serious with you. I literally came home and I messaged Renando like 5 minutes after I got home, and I was like, dude, gold left me behind. And instantly I was then saying, if I do get back into this order, I'll need to wait for it to come back up to me again. Eventually it did come up, but there was a news candle that triggered, so I couldn't trade this news candle. And essentially this trade would have been a good trade to take, would have been really perfect if that news candle didn't do that. Because this news candle caused it to push up massively and then just reject, and I couldn't take that position. So this gold trade that I waited for a week, I couldn't even take it. Like this entire zone here, I couldn't take because we had a news wick that played out like that, and I couldn't go down, right? It's important to understand this because what I did essentially was draw this out, waited a week for it to get there, just to not get the position. Like this would have been a perfect position. If this candle didn't actually wick up there, I would have been able to get in, and I would have made 1 to 5 already. It would have been 1 to 5 over here. But I was looking to go short all the way down to these lows here. I wanted to go short all the way down to here for a simple 1 to 12. Yeah, so it's about a 1 to 12. Okay, so if this goes down to here within the next 2 weeks, or within the next week, I'm not really going to be upset. All I'm really going to do right now in this situation, I missed the position, it's fine. I'll just wait for the retracement. Okay, because there will most likely high chance of us actually coming up to the retracement, getting a nice retracement up, getting a short somewhere off of here. If I grab my there, so we can probably come up to this area here. So I want to look at, and then short down from there. So I didn't get the initial position, but I'm waiting for that retracement, right? It's understanding that patience is key, right? Waiting for the setups to come to you and not chasing the market. Where are these notes? There they are. So I'm going to add that in as the next one. Patience. Make this right. There you go. Patience is key. Okay. Extremely important thing to understand as a trader and as someone that's trying to become profitable is that you cannot be chasing setups. If you don't see a setup on one time frame, another time frame won't give you a setup, essentially. Right? You're trying to force a setup out of the market that cannot be made, essentially. Okay. So the next thing I want to talk about is... Actually, wait, can anyone else tell me anything that you think the pros do that the quote-unquote retail don't? I say quote-unquote because it's like we're all retail. Everyone that isn't an institutional trader is a retail trader. Doesn't matter how much money they have. Unless you're an institutional trader trading with absolute billions, then no, you're going to be retail. Know your exit before you enter. Pros: follow a strategy and stick to it. Okay. Know your exit before you enter. That one comes straight to something that I actually told a friend a few months ago when he started trading. Was it's actually the perfect thing to actually say is you need to have a SL and TP before the trade, right? Professional traders don't just decide to have a take profit or a stop loss, right? They calculate the trade before they take it. They know exactly where the stop loss is going to be. They know exactly where the profit's going to be. They know exactly how much they're going to be risking. They know exactly what's going to happen if their trade loses. They know exactly what's going to happen if their trade wins. They promise you that they already know how they're going to use the money once the trade wins, right? It's a very important thing, is because if you don't have a strategy or you don't have a take profit or stop losses, you're going to be thinking, oh no, maybe I can ride this to the 4-hour low, where you're taking the trade on the 5 minutes and you're like, I'm going to ride this to the 4-hour low. Yeah, it's important to understand. Pros follow the strategy and stick to it. I like that as well, right? So the professionals essentially trade like robots, no emotions, right? This ties in with the risk management, right? So essentially, a lot of the times, what you'll see when people blow their accounts is that they'll lose 2 trades in a row, and then on that third trade, they'll want to make back the money that they lost in the first 2 trades. So they'll risk more. So they'll go ahead and they'll start applying more risk to the trades, then they'll lose the next one, and all of a sudden now they've lost more than what they would have. So now they've lost 2 trades in a row, and the third trade they've lost is now essentially at a higher risk. So they've lost 4 or 5 trades in a row, basically with the amount that they've lost, and then it just spirals down. So every trade they take, they are risking more because they want to make back the money they just lost. Right. So that's a lot of the times you see that happen with people that are new to trading or people that don't have their mindset under control, is they'll risk 0.25% on a trade. They'll lose 2, so they'll be down 0.5% on the account. And then all of a sudden they'll be like, oh, I need to make that money back. So instead of risking 0.25 again, they'll risk 0.5. Then they'll lose that one. And then they'll be like, oh, I need to make that money back, and they'll risk 1%. Right? You see how as the account goes down, they're risking more. That's not what you're supposed to do. Like that's the opposite of risk management. It's as your account goes down, the less you have to risk. Yes, it's going to take you longer to make the money back, but it'll also teach you a lot along the way. Right? It'll teach you to be patient. It'll teach you to understand how your money operates. Right? It'll teach you to understand how the trades operate. It'll teach you to understand that some things can't just happen tomorrow. Some things can't just happen overnight. The things that will change your life will most likely not happen overnight. Most likely. Sometimes it can. The problem is you make a small profit and you want to take profit before you lose it all, although you have not reached TP. See, to me, that's personal, right? So for me, sometimes if I see a trade and I'm in the trade and I see a sign of a reversal, like let's say I take a long on something and I see a sign of a reversal, I see a candle I don't like, or I see a liquidity grab that I don't like, then I'm getting out of the trade with the profit that I have, right? Because the thing is, I'll rather secure something than secure nothing. I'll rather secure $100 than let that trade come back to break even, right? A lot of the times what I'll also do is if I see a sign of reversal, I'll close half of the trade. Then I'll let the rest run. If it gets stopped out, it gets stopped out. If it goes to TP, it goes to TP. So that's something important to understand, is that you will trade differently to the way I will trade. If I see a setup and I take the setup and I see a sign of a reversal, I'm most likely going to be taking some of that off and letting the rest of it run. Or what I'll do is I'll probably even close the trade in full sometimes, look for a better entry. Right? How long do you think the average pro trades per day? It depends. I know some people, well, I don't know them personally. I know of some people that take trades like once every 2 weeks. And that's not even saying they will take it every 2 weeks. It's just saying that they only see a setup like once every 2 weeks or so. Between 1 to 2 weeks, they'll see a setup and trade it. I know some people that scalp the 1 minute. Like some people go out, trade like 2 hours a day, and just scalp on the 1 minute time frame, get 3 good trades, and then they're out for the entire day. Like it all depends. Like a lot of the times what you'll realize is the bigger your account gets, this isn't how it always works, but a lot of the times is the bigger your account gets, the less you'll start trading because your profits will be more, right? So essentially, if you have $1,000 account and you're risking 1% and you're going for a 1 to 5 trade, you're only making 5% back per trade. But if you have a $100,000 account and you go for a 1 to 5, you're making $5,000 per trade. Okay. And if I'm making $5,000 a trade, I'm only going to be trading once every 2 weeks. Try to get 2 wins in a month. That's all I need. So I can wait for the perfect setup. I can wait for that exact moment that I can go long. I can or short. I can wait for the market to come to me because I know at the end of the day, I can make $5,000 off of this. Right. So do you understand that this isn't how everyone trades? I'm just saying this isn't how everyone trades, but that's essentially what some people do. Okay, so some people might do that where another person might come along and say, okay, cool, I have $100,000 account. I'm going to trade the 1 minute time frame and I'm going to scalp the 1 minute time frame, but I'll only risk 0.5%. So if I win a trade, I make about $2,500. But because I'm scalping the 1 minute, it's more volatility. So I'm going to be risking less. But I'll be trading more. So I'll be making the same amount. So essentially, these two people are making the same amounts of money, but they're trading different ways because they like to trade in different ways, right? So that's the most important thing to understand is that two people can have two different strategies, and two people can be on two opposite sides of the market. Like I could go long and you could go short, and both of us could make money because my long could go into your short entry, and I could TP where you want to short, and then you can go short and TP where I entered on my long, and boom, we both just made money, right? So it's important to understand those things. If you wanted to maybe trade on a 5 minute trade, what is the average time you'll spend in the whole trade? It depends. So it depends. Like there's no answer to that because if you're trading on the 5 minute time frame, it doesn't mean your trades will necessarily clear quicker. It just basically means you might get more setups a day, just because candles move faster on the 5 minutes, like or zones might get tapped faster on the 5 minutes because there'll be different zones you'll be looking at, right? So for example, let me go to let's go to US oil real quick. Okay, if I go to the 4 hour time frame, to take a position on the 4 hour, right? Let's say you went long down here, right? You would hold it until this high most likely, and that would take a couple days, okay? But at the same time, you could be on the 5 minute time frame. Let's go back down to that area. You could be on the 5 minute time frame, and you could look for a long off of this pullback, right? And you could go long over here, but the thing is, you could have the same TP. You could go long there on the 5 minute, but you'd have the same TP as over here, and still wait a couple days for it to clear, right? So that's the important thing to understand is that just because you're on a lower time frame doesn't always mean that your trades are like quicker. It depends on the strategy you're trading, right? So I'm going to give you an example over here. So it's a trade that played out earlier this week, right? There was a liquidity phase that played out. Liquidity build up over here. The entry was down here, and I just wanted to ride it up to take out these highs. On this strategy, this trade would have played out in exactly 30 minutes. Okay. But at the same time is I could be looking for this entry to long it on the 1 hour time frame up to these highs over here. And this trade would have still been in. So this trade would have taken this market from here to here. This trade would have been 1 day, 6 hours, and it still would have been in. Right. So that's important to understand is that the time frame you're on doesn't always mean you're going to be in and out quicker. The time frame is just price action in detail. That's all time frames do. It just gives you more detail with price action. Right? It's very important to understand this. Where are my notes? I keep losing them. There they are. That's the important thing to understand, is that I'm not going to say it again. So yeah, thanks, dude. No problem, bro. What do you suggest for beginners with small account sizes? How often shall we trade? It depends on you. Like that's the thing, is that I can never tell you this will work, because what will work for me will not work for you. So for me, if I was a beginner, I would look to take a trade. Actually, no, I wouldn't look to take a trade once every. I would look to find a strategy that works for me. I would look to find a strategy that's the most profitable strategy that I can trade. One. Two, I would look for a strategy that matches with my mentality, that doesn't make me stress 24/7. That's two. Three, I would say I would stay away from low time frames as a beginner. First of all, stay away from low time frames. Like don't be on the 1 minute and the 5 minute. That's three. Number four is understanding that you won't triple your account in a week. You won't just make bank. If you're a beginner and you have a small account, you won't just become a millionaire. It'll take you a while, right? The thing that I explained to someone the other day was, if your account's on $100, let's consider this a small account. If your account's on $100 and you get that account to $200, that's 100% gain. Do you understand how much percentage gain that is, right? So it leads me on to the next topic, or the next thing, is that pros work in percentages, not numbers, or well, not money. Say money, right? So a pro sees this as 100% gain, where if you for example, if you walk to someone and you tell them, hey, what's up, dude, I just made 100% of my account, they'll be like, holy shit, dude, that's insane. But if you walk to someone and just tell them I made $100 while trading, they'll be like, that's nothing. But if you tell them percentages, which is actually what you're doing as a trader, you work with percentages all the time. That's the only thing you do. It's percentage, percentage, percentage. Risk management is percentage. How much you gain, percentage. It's all numbers, right? So essentially, if you have a $100 account, to get that account to 200, it's 100%. If you do that again to the same account, it becomes 400. It's the same percentage gain, right? And let's say this takes you 2 months. Actually, no, let's say it takes you 6 months, right? It should take you another 6 months to get to 400, right? And then it'll take you from 400 to 800, another 6 months. From 800 to 1,600 and onwards and onwards and onwards, right? But the tricky thing, or the trip, comes in when your account is at $10,000, right? When your account's at $10,000, this is the interesting thing. That's 100,000. That's not 10,000. Your account's at that was 10,000. I'm being stupid. $10,000. 100% that, you're on 20,000. Boom. 100% that's 40. Then you're at 80. Then you're at 160. Right? Once you're at 160, right, you get to 320 actually. So you get 320, right? So the more you have, the more you're able to gain on it. But now watch this carefully. I'm not saying that you should start with more money. That's not what I'm saying. Because if a beginner opens up the account and they start with $10,000, they should say you have $10,000 lying around, and you start trading with $10,000 and you have this mindset, you'll lose it all. It's because you, first of all, don't have a profitable trading strategy. You don't understand risk management. You don't understand market structure. You don't understand how to draw support and resistance properly. You're going to lose all the money anyways. It only comes in when you become profitable, right? Having more money is only a benefit to you if you are already a profitable trader. If you are on paper profitable, then essentially in real life you should be as well. When I say on paper, I don't mean a paper trading account. I mean you took 100 trades and you collected all the data and you won 60 out of the 100 trades. You have a 60% win rate. On paper, you're profitable. That's what I mean. Someone says, started with a $1,200 account, don't know what I was doing, so I have lost half of it, so I don't know. So I don't want to add any funds, want to find winning system, etc., to build up the remaining 600. That's exactly what it is that you start with money at the beginning, you will always lose it. And then it's the the real thing comes in is where you actually decide, oh, we need to now work on a strategy, become profitable with the strategy, and then start making the money back. Right. So if you think about it, like how much money is like a decent amount per month? $1,000 is a decent amount to make per month. So the thing is, if you, let's say you could get 600, let's say you can get a $600 account and double it in 2 months. It's not that tricky. You can do that with a 1 to 5 strategy. Right? You double that in 6 months. Now you're at 1,200, right? All you have to do is essentially get your account up to a specific size and then focus on risk management. So what I mean by that is, let's say, right, you have a $10,000 account, right? You have a $10,000 account and you want to make $100 a day. Please correct me if my math is wrong, but that's 1% a day. Yeah, that's 1% a day, right? Means you have to make 1% a day. Now watch this carefully. If my account, so if you make $100 a day, by the end of the month you should essentially have $3,000. Okay, because there's about 30 days in a month. Now watch this. If I have $100,000 account, I'm not targeting to make a shit ton of money. I'm still targeting $100 a day. The only thing that changes is the amount that I have to make. So it's what, 0.1%. Do you know how easy it is to make 0.1% on an account in a day? You could literally take a trade, just wait for it to go, just wait for it to move, and then take profit. That's it. That's literally all you have to do. Right? Essentially, you could essentially, if you're not greedy, you could make this in like 2 seconds with the right strategy. You could literally wait all day for one trade to get into your zone. Take the trade, and as soon as you take it, 2 seconds later, close the trade, and you'll make your profits for the day. You'll probably make your profits for like a week. Right? So it's understanding, it's like risk management. It all comes back to risk management. It's the most important thing that you have to understand as a trader on any level. I've started with just 3 times 250 accounts so that I don't blow off all I can trade before I develop a good system. Good. Just like that. Okay, no. How do we find the strategy? Okay, so what you would do, okay, how do you find a strategy that you can trade? Is I would say is literally look up a whole bunch of them. Like try a lot of them out. But I don't mean try them out with a real account. I mean try them out like with a paper account first. Right? So try like the retail. Look, trading support resistance isn't a bad thing. You get 6-figure traders trading support and resistance, right? So trade the normal support resistance way. Try that out. Paper trade it on TradingView. Okay. Then trade it for 100 trades. Do it for 100 trades. Okay. Once you do it for 100 trades and you track every trade, have a journal, right? Track every trade. An alert's going off. Okay. Track every trade for 100 trades. After that, you should essentially have a win rate. You should have a win rate because you've traded 100 trades. You can then say, how much have I lost? How much have I won? How much was break even? Okay, cool. I lost 30 trades. I won 70 trades. Okay, I have a 70% win rate. Now you know that you can do it. You then go and do the exact same thing with a real account, right? So now you put funds in. Okay, so now you put like $100 in. You risk 1% per trade. And then you try and see if you can trade that strategy with real money. And you see how your mindset changes and how you manage the trades differently. Because trading with paper, like paper trading is easy. Anyone can do it. I can take $100 account and turn it into $1 million in like 2 weeks if I'm paper trading. Because risk management isn't real then. Like it's not really a thing. Your brain isn't click that it's real money, so it won't activate your emotions. But as soon as you then put your own money in and then start trading, even if you put $100 in and risk is 0.5% or 0.1%, right? Then you track it for 100 trades to see how you do with real money. And then boom, if you then are profitable on that strategy and your data shows you that you're profitable, then boom, you can put more funds in, or you can then start changing your risk. Instead of risking 0.1%, you can then start risking 1% and start growing your account from there. But it's all dependent on what you want to trade and how you trade. So for me, I can trade on a day-to-day basis because it's what I do. But for you, you might not have the time. You might be at work. So for you, you might only have 2 hours a day to trade. You can only log on in the evening. So you then have to go and check the data. If you log on every evening, how many setups do you get in a month? How many of those setups out of 100 trades, how many of those setups were wins? Blah blah blah. Essentially, you just get the data. I'm so sorry I have to go. I'll look at the recording. No problem, bro. Find one you like, learn as much as you can, backtesting strategy as many times as you can until you start to see the trades when you open the chart. Exactly, that is it. So the next thing I also wanted to say is backtesting. So understanding that you need to practice what you do. Okay, so if you find a strategy that you like, you go backtest it. See if you can trade the strategy. See if you can mark up support resistance properly. See if you can mark up supply and demand zones. See if you can mark up liquidity. Right. So it's important. Losing and learning from your mistakes and stick to what works for you. I learned fib waves, trend lines, support and resistance. Exactly. I don't know who I was talking to this week. I was talking to someone. You guys are all literally giving my points before I can even say them. I was talking to someone this week. Not sure who it was, but I was telling someone that everything bad is good. I think I was speaking to Lilius and Vicky. I think it was one of you two. I was giving the analogy of everything bad is good, right? What I mean by that is anything bad that happens to you in your life will always be bad until it makes you do something that you would never have done if that didn't happen. Okay, so I've said that out loud. Let me explain to you in a different way of what it basically means. Okay, you can get into a car crash today, right? You could get into a car crash. Tomorrow, all of a sudden, you are driving a lot safer. You're watching people on the road differently. Now, that is a good thing because this bad thing happened, but it changed the way you do things on a daily basis. So there, it's now a good thing that happened, right? If it didn't change the way you were driving, then it's going to still be a bad thing until you eventually change it, right? The same way with trading. If you lose a trade, it's a bad thing and it will impact you negatively unless you go back and you learn from it and then take a trade differently depending on what happened. So let's say, so what happened with me this week, right? Show you exactly what happened. I was trading US oil, right? And this exact trade that I marked off earlier, this exact trade over here that I marked off, I took a long top of this zone. That's a short. Whoops. I took a long at the top of this zone. Stop loss was here. Take profit was up here. Okay. After we got, show you here, went long over there. I'll show you exactly what happened to me this week. I went long over here. Next candle comes out red, right? Now I'm thinking, okay, cool. As soon as we break above this, I'm moving stops to break even. Boom, stop loss to break even straight away. Now watch what happens here. Was it here? Let me see. Yeah, there you go. Stop loss to break even. Boom, got wicked out. Okay, so I got wicked out of this trade over here because I moved my stop loss to break even. What happens after that? We just freaking moon. Straight away, we just moon. Okay. What did I do? I now know, okay, when I'm trading US oil, I mustn't move my stop loss to break even so quickly. One. Number two, I can expect volatility and high and getting wicked out on US oil. Now that I understand this, next time I take a trade on US oil, I'll have that in the back of my head. So I'll then wait to see if we get that liquidity grab or to see if we get that initial kind of volatility where the market's moving a lot, right? It's important to learn from your mistakes. Even if it's not a mistake, even if you get stopped out, understand why or understand how the market moves. Even if you don't understand why, like I didn't understand why oil specifically wicked me out, but I did take note and say, okay, cool. Now I know not to move my stop loss to break even so quickly when I'm trading on US oil. Right? It's important. All things that you need to know. So why you have the rule of 50% on SL to entry point? Why do I have it? Just because I like to secure my trades. So for me personally, when we make a higher high, then on the time frame that I'm trading on, so if I take the entry on the 5 minutes, if I enter a trade on the 5 minutes, I'm going to manage the trade on the 5 minutes. And if we make a higher high or a lower low on the 5 minute time frame, my stop loss goes straight to break even to protect my trade, one. And two is if we come back up and I get stopped out, we are back at entry, so I can look for another position. Right? So essentially when I move stop loss to break even and I clear 50% profit, I know, cool, I've made my money for the day. One. Two, if we come out and it stops me out, then I can look for another trade because it's at entry again. So, boom. It's a really good way of like thinking at it. Like if you are watching the trade and you can keep your eye on it, moving stop loss to break even is never really a bad thing because you can always get another entry. But it just protects you. So yeah. Is there any more questions that I can take? Well, everyone's here. We have 37 members. What's up, people? Welcome. We have a lot of new names here as well. A lot of new names here. What's up to the new people? Welcome to the channel. If there's no more questions, then I can say my last words, and then I'll be back on in like 20 minutes for the weekly analysis. Once again, weekly analysis this week also will not be a long weekly analysis. Just gonna want to go over a couple of things. How often do I come on? Every Sunday we'll have a free educational stream. And then every Sunday we also do the free market breakdown for everyone. And then on top of that, I trade throughout the week. Let me actually just change this. Let me stop the recording.